Most people think they are investing in companies. They are not. They are investing inside a debt machine that must keep moving forward or start eating itself. That is the first thing I would want you to understand if I were sitting across the table from you in 2026 and you asked me what to do after a stock market drop. When markets fall, most people start searching for a safer story. They ask whether bonds are still safe. They ask whether gold is still safe. They ask whether cash is finally king. They ask which headline caused the damage. They ask whether oil did it, whether war did it, whether politics did it, whether the Federal Reserve did it. Those are not the first questions I ask. I ask a colder question. What kind of machine are we standing inside? Because once you understand the machine, the panic starts to look less like mystery and more like mechanics. And the mechanics are brutal. We built a world that is carried by debt, government debt, corporate debt, mortgage debt, auto debt, credit card debt, student debt, margin debt, debt layered on top of debt, then priced by markets that also depend on confidence. Rising collateral and rising income. That means the system does not merely prefer inflation. It leans on inflation. It needs wages to rise, profits to rise, asset prices to rise, and tax receipts to rise. It needs all of that because yesterday debt was issued under the assumption that tomorrow would be larger than today. If tomorrow stops getting larger, the numbers begin to fight back. That is why most people misunderstand stock market drops. They think a drop is always a verdict on value. Very often it is a demand for oxygen. They think money is leaving bad assets. Very often money is leaving liquid assets. They think the world has suddenly decided that gold is bad, bonds are bad, stocks are bad, crypto is bad, everything is bad. That is usually not what is happening. What is happening is simpler, uglier, and much more dangerous. People need cash now. I learned a long time ago that if you want to understand a panic, you should not begin with opinion. You should begin with who owes what, who borrowed against what, and who gets a phone call first when prices move the wrong way. That phone call is where real fear lives. Let me put it in plain English. Imagine a man who owns a fine house with a large mortgage. As long as his income grows, he feels intelligent. As long as his salary rises and his assets keep appreciating, his debt feels manageable. He may even feel rich. Then his income stalls, or worse, it falls. The house did not move. The mortgage did not become larger overnight. But the ratio between his obligations and his income changed, and that one change can turn comfort into danger very quickly. Now magnify that from one household to an entire financial system. That is the operating system. Most people are trying to invest inside without ever naming it. I would name it for you like this. It is a debt expansion system. That system can tolerate many things. It can tolerate politics. It can tolerate bad headlines. It can tolerate wars that frighten television. It can tolerate bubbles longer than critics can tolerate watching them. What it cannot tolerate for very long is broad deflation, sustained asset collapse, and a long period where cash flows fail to keep up with fixed obligations. That is the crack in the wall. And if you do not understand that crack, you will read every market decline as if it were random weather. It is not random weather. It is plumbing. When I say the system needs inflation, I am not saying every price must go up in a straight line forever. I am saying the system depends on nominal growth. It depends on incomes that look larger, profits that look larger, tax collections that look larger, asset values that look larger. Without that, old promises become heavier. A lot of people are morally offended by that. I understand it. I do not love it either. But markets do not care what offends us. Markets care what must happen to keep the machine from seizing. That is why I become very suspicious. Anytime I hear the average investor say, everything fell, so the whole system must be resetting. Usually it is not resetting. Usually it is being forced to sell. And that brings me to the second mechanism. I call it the collateral scramble. You may own wonderful assets and still be in danger if you borrowed against them. A man who owns a business with no debt can afford to be patient. A man who owns the same business with borrowed money must answer to time. That is why leverage looks brilliant on the way up and tyrannical on the way down. If an investor has $1 million and borrows another $300,000 to invest more aggressively, he has not merely bought more upside. He has shortened his emotional fuse. He has attached a timetable to his judgment. He has invited a third party into his decision, making now prices fall, not forever, just sharply enough. His broker does not ask whether his companies are wonderful. His broker does not ask whether the war will calm down in 2 weeks. His broker does not ask whether the sell-off is irrational. His broker asks for collateral, and if he cannot provide it, positions are sold, not the positions he most wants to sell, the positions he can sell. That distinction matters more than most people realize. In a true liquidity squeeze, investors do not sell according to philosophy. They sell according to speed. They sell what can become cash fastest. That is why you can see stocks fall, gold fall, bonds fall, silver fall, crypto fall, and people start muttering that nothing makes sense anymore. It makes perfect sense if you understand the hierarchy of panic. In ordinary fear, people sell risk. In a liquidity event, people sell liquidity. That is why a sell everything moment does not automatically mean every asset has suddenly become unattractive in the long term. It often means cash has become urgently attractive in the short term. This is one of the most expensive misunderstandings in modern investing. People watch a broad liquidation and conclude that safe havens have failed. Sometimes they have not failed at all. They have merely been converted into emergency funding. If a man owns rental real estate, physical gold, and a portfolio financed with margin, and he gets hit with a margin call that must be satisfied immediately, he is not going to sell the apartment building in 48 hours. He is going to sell the gold or the listed stocks or whatever else can be turned into cash before the deadline closes on him. He is not expressing a view on gold. He is surviving his leverage. And once you see that clearly, an enormous amount of market noise becomes easier to endure. Now let me take you one layer deeper. The third mechanism is what I call the inflation ladder. Most people hear inflation and think only of groceries, gas, and irritation. I think first about debt service, because when you owe money in nominal terms, a world of rising nominal income can rescue you in ways that morality never will. If your wage rises from $100,000 to $150,000 while your mortgage balance remains fixed, your debt burden shrinks relative to your income, even if your real standard of living does not improve by the same amount. That is why debt-heavy systems are biased toward inflation, not because inflation is noble, because inflation is convenient to debtors, including very large debtors. Governments especially like this arithmetic. It is far easier to carry an enormous debt load when tax collections rise, because nominal wages, nominal spending, and nominal asset prices have all risen too. This is not a conspiracy to me. It is arithmetic wearing a necktie. And if you understand that, then you understand why policymakers fear deflation far more than the average citizen does. The citizen thinks lower prices sound pleasant. The system sees lower nominal income, weaker asset collateral, weaker tax receipts, and a rising real burden of outstanding debt. The citizen sees relief. The system sees destabilization. That is why I tell people not to confuse short-term pain with long-term direction. A debt-driven system can wobble violently, it can even panic, but its reflex, again and again, is to restore nominal growth. Sometimes that comes through lower rates, sometimes through liquidity facilities, sometimes through direct and indirect money creation, sometimes through fiscal expansion disguised as rescue, stimulus, national necessity, or stability. The label changes. The impulse does not. So when you ask me how to invest after a drop, I do not begin by asking whether the latest shock looked scary on television. I ask whether the deeper machine has changed. Has the world suddenly decided it can tolerate deflation? Has the political class suddenly embraced a prolonged purge of leverage, bankruptcies, collapsing tax revenue, falling home prices, falling stock prices, and mass unemployment? Number, that is not how these systems behave. They postpone, dilute, inflate, refinance, subsidize, stretch, and paper over. They may not cure the disease, but they try very hard to prevent immediate cardiac arrest that matters for how you behave. Now, I want to give you a diagnosis most people do not want to hear. A lot of investors are not actually afraid of losing money. They are afraid of holding volatility long enough for the system's bias to work in their favor. They say they are long-term. Then they treat every drawdown like a referendum on their intelligence. They say they want to build wealth. Then they demand emotional certainty at the exact moment the market is offering them a discount. They say they hate debt and manipulation and money printing. Then they keep their capital positioned as though the old order will disappear next Tuesday. That is not analysis. That is emotional inconsistency. You must decide where you stand. If you believe the debt machine will continue to demand inflation, nominal growth, and higher asset values over time, then you should behave like a person who understands the regime. If you believe the machine is about to be replaced by a cleansing era of honest money, prolonged liquidation, and no intervention, then you should structure your life for a very different world. But do not live in between. Do not hold the opinions of collapse with the portfolio of a tourist. Do not hold the opinions of optimism with the nerves of a gambler. This is where identity enters the picture. Most people think they are investors. In a panic, they reveal that they are renters of conviction. They borrow their view from headlines. They borrow their courage from yesterday's green candles. They borrow their time horizon from the mood of the week, and the market strips them for it. I do not want you to be that kind of owner. I want you to become the kind of owner who knows which mechanism he is betting on. So let me name them cleanly. The first mechanism is the debt machine. Rising nominal growth helps the system carry yesterday's promises. The second mechanism is the collateral scramble. In a liquidity crunch, people sell what they can, not what they want. The third mechanism is the inflation ladder. Policymakers will usually choose inflationary survival over cleansing deflation. The fourth mechanism is the intervention reflex. Recession and deflation are politically tolerable only in speeches, not in practice. The fifth mechanism is the ownership gap. Most people know these truths intellectually and still fail to invest according to them because their behavior collapses when prices do. Once you see those 5 mechanisms as one operating system, the next step becomes much more practical. You do not need to predict the exact bottom. You do not need to predict the exact date of peace or the exact path of rates or the exact month when fear turns into greed again. You need a protocol. And I will give you mine first. Stay invested in productive assets. I have spent my life preferring productive assets over sterile promises because productive assets adapt. Good businesses can raise prices, gain share, reduce waste, innovate, and compound. They are not perfect shields, but they are better long-term partners than cash sitting still while the currency beneath it is slowly diluted. Second, treat sharp declines as repricing events, not invitations to emotional theater. If the system's core bias remains inflationary and pro-nominal growth, then dips in productive assets are not pleasant. But they are useful. You do not need to lunge at them with all your cash in one move. You simply need the discipline to average in while others are still demanding certainty. Third, avoid excessive margin. I am not saying leverage never works. I am saying it turns patience into dependency. It creates a situation where being right eventually can still destroy you immediately. One of the saddest ways smart people go broke is by being correct too early with borrowed money. Fourth, diversify with intent, not with fashion. An S&P 500 fund gives you ownership in a broad slice of American business. International exposure keeps you from worshiping one geography. Precious metals can serve as monetary insurance in a world that keeps solving debt with more currency creation. I would not build a life on a bar of gold, but I would not build one without understanding why some insurance belongs in a debt-saturated system. Fifth, separate liquidity from panic. You need some cash not because cash compounds magnificently over the long run, but because cash buys you the right not to become a forced seller. A modest reserve can protect a magnificent portfolio from bad timing. 6. Refuse to confuse a ceasefire with a cure or a sell-off with a new era. One headline can loosen a liquidity squeeze. One easing in fear can send markets snapping back toward their old trajectory. If de-escalation reduces the urgent need for cash, the machine does what it usually does. It reverts toward reflation, expansion, and higher nominal asset prices. That does not mean the system is healthy. It means the system is resuming its preferred method of avoiding immediate pain. There is a great difference between health and continuation. Investors who understand that difference stop waiting for perfection. Now let me say something that may sound harsh. The market drop itself is usually not what ruins people. The meaning they assign to it ruins them. They see a sell-off and conclude that their plan was naive. They see gold falling with stocks and conclude that nothing works. They see bonds failing to rescue them in a particular window and conclude that the old rules are dead. What they are really seeing is stress transmission when enough debt sits on enough balance sheets. And enough leverage sits in enough portfolios. Stress does not stay in one corner. It transmits. It jumps across assets. It forces liquidations that look irrational if you study only price and perfectly rational if you study funding. This is why I dislike the modern obsession with constant explanation. Television wants one villain. Real markets usually deliver 5 mechanisms at once. Oil can rise and scare inflation. War can raise uncertainty. Margin can accelerate liquidation. Policy can distort timing. Debt can determine the boundaries of what officials are willing to tolerate. And somewhere in the middle of all that, Ordinary people are trying to decide whether to buy, sell, hide, or freeze. My answer is not glamorous, own reality. Do not own slogans. The reality is that we are in a debt-laden system that is structurally biased toward inflation, intervention, and higher nominal prices over time. The reality is that violent drawdowns happen anyway because leverage and panic create temporary demands for cash. The reality is that those two truths can coexist. Once you accept that, your job becomes less theatrical and more disciplined. You stop chasing the one correct headline. You start building a repeatable response. When prices fall, you ask 3 questions. Has the productive capacity of what I own been permanently impaired? Has the regime changed in a way that truly breaks the debt expansion logic? Am I reacting to a solvency problem or to a liquidity problem? Those 3 questions will save you from a great deal of stupidity. If the answer to the first question is no, if the answer to the second question is no, and if the third question points mainly toward liquidity stress, then your posture should not look like surrender. It should look like measured accumulation. This is where the average person usually rebels. They say, but what if it gets worse? Of course it can get worse. It often does. That is why you average. That is why you avoid leverage. That is why you do not spend emergency cash pretending to be a hero. That is why you build a process instead of a dramatic moment. Investing is not won by predicting the loudest week. It is won by aligning yourself with the deepest force and then surviving its volatility. In this regime, the deepest force is still nominal expansion. Not moral clarity, not elegant theory, nominal expansion. That is the river. You do not have to admire the river. You do have to know which way it flows. I also want to say a word about gold, because too many people talk about it like a religion or dismiss it like a relic. Gold does not create cash flows. I know that. I prefer businesses. But I also know that gold is not owned for the same reason. A railroad or a utility or a candy company is owned. It is owned because there are periods when trust in paper promises weakens and people want a monetary asset outside the earnings claims of a particular business and outside the liabilities of a particular government. In a world that keeps solving debt stress with more currency and more intervention, I would regard some precious metal exposure as monetary ballast, not as a religion and not as a substitute for owning productive assets. The same principle applies to international diversification. A great many investors speak as if one country will absorb all future growth forever. I would rather not make my financial future depend on one political class, one central bank, one fiscal path, one consumer culture, and one valuation regime. Diversification is not a confession of doubt. It is a recognition that the future does not need my patriotism to unfold. So what would I do in 2026 after a market drop? I would keep buying productive assets gradually. I would keep my leverage low enough that volatility cannot dictate my behavior. I would own some international exposure. I would own some precious metals as insurance. I would refuse to run in and out of the market trying to act smarter than a machine that is structurally designed to punish overreaction. Most of all, I would stop thinking like a spectator and start thinking like an owner, because this is the real dividing line. Spectators need reassurance. Owners need a plan. Spectators watch the machine and complain. Owners study the machine and position inside it. Spectators want the all clear. Owners know the all clear usually arrives after the cheap prices are gone. Now let me bring this to the final test, because every serious investing philosophy should end in one. If your portfolio fell hard this year and your first instinct was to search for a perfect narrative before taking any action, then you are still asking the market to make you feel safe before you behave rationally. That is not ownership. If your first instinct was to borrow more and swing harder because dips always bounce, then you are not an investor either. You are a volunteer for the next margin call. The test is simpler than that. Can you look at a system you do not fully admire, understand the bias it cannot easily escape, and still build a disciplined life inside it? Can you own productive assets without borrowing recklessly? Can you hold some monetary insurance without worshiping catastrophe? Can you buy during fear without needing to predict the final low? Can you let process outrank ego? That is the threshold. And if you cross it, something important changes. You stop trying to win each week. You start building a future self who is hard to shake. That future self does not need every crisis to be mild. He only needs his behavior to remain sane while the machine does what machines do. So here is the contract I would ask you to sign with your future self. I will not confuse liquidity events with permanent truth. I will not borrow so much that volatility can evict me from my own convictions. I will not wait for comfort to buy what fear has discounted. I will own productive assets, hold some insurance, stay diversified, and let discipline do the work my emotions cannot. If you can keep that contract, then a market drop in 2026 is not merely something to survive. It becomes one more chance to act like an owner in a world still ruled by debt, still addicted to nominal growth, and still trying, however clumsily, to inflate its way past yesterday. S promises